Hello everyone, today is Friday, January 7th, 2022. My name is Evan. Welcome back to our weekly stock market analysis videos. If it's your first time tuning into one of these videos, welcome. Thanks for joining us. Thanks for being here. Here's how we break up our analysis. We split things up into two parts. In part one, we look at everything that's going on this week in markets. We go beyond price and look at things like correlations and market internals and credit markets, and really sort of just pick apart everything that stands out, looks different or interesting. And then in part two, we jump into the charts. We look at those trends over a longer term time horizon and try and best position ourselves and make sense of the action more broadly. So hopefully that sounds good to you. Let's jump into some of the takeaways to this relatively vicious start to a new year. This is one of the poorly performing first weeks of the new year, to put it lightly. We had an ugly start basically for stocks broadly. We had an ugly start for the bond market as well. And so between the two of them, you know, if you were in risk assets, you got beat up. If you were in the defensive area of the market, frankly, you got beat up as well. Where we did see some standout performance was in oil and energy stocks specifically. Don't even want to say commodities generally, because a lot of commodities got hit, but oil, energy stocks, they were certainly some standouts. There were a few other pockets of strength, but it was pretty rough out there, just broadly speaking. If we take a look here at the 1 week numbers, so you can see the Dow Jones absolutely kind of standing best here on a relative basis. It was nearly flat. It closed lower, but not too bad compared to, say, the S&P 500 down 1.7%, the Russell 2000 down almost 3%, and the Nasdaq getting hit the hardest, 4.5% to the downside. So lots of unwind there in the growth and even, you know, large cap, mega cap space as well. What's interesting is we had world stocks doing quite well this week. They closed basically flat, which again, on a relative basis is quite, you know, strong compared to what the US did in this first week of trading. So let's dig a little bit deeper here. Let's go to market internals. Market internals have been firming back up. So this has been a story we've been on top of, you know, over week. Every time we do these videos, market internals is a center point here for us. And so, you know, November, we had that big decline in market breadth and participation. And then going into kind of mid to end December, we started to see some stabilization and some rebound. We actually see a reasonable amount of strength up here on the 52-week highs minus lows. Remember, Friday's numbers are not finalized numbers, so I take these early. So this could be, you know, a little bit lower. I suspect it might come in a little bit lower. Regardless, though, we've seeing a little bit of positivity here underneath the hood. Now, a lot of that is going to be sector and stock specific. Maybe that's the energy complex, which is now starting to run, in industrials and maybe even some real estate. Like, there are little pockets of strength that can be driving a lot of some of this positive breath under the hood. But this is still something that I think is interesting and notable, is that we're not seeing the severe rollover negative 52-week lows being made like we saw in November, at least not yet. So we'll see what next week brings. For now, it's still hanging in there. You can also see the AD line here was negative 1200. Again, negative number, but not horrible in terms of market breadth. You can see the percentage of stocks over 20 SMA starting to unwind back down to 59.8, which is, you know, actually still kind of high. If we take a look here at the 52-week highs minus lows, again, this thing looks like a mess. The downtrend that was in place is trying to get broken, but now you can see we're starting to flatline, and this is where things get interesting next week for me. I'll be paying attention to this, is do we start to roll back over here, or can we put in, you know, some stabilization, and can, you know, the number of stocks hitting 52-week highs continue to outpace? That's going to be a big question. That's something I'll be looking at. But frankly here, this is a very mixed picture on 52-week highs minus lows. So let's, you know, kick it out another week here and see what this trend looks like. If we take a look at sector performance, you can see again, very split here. If you were in energy or financials this week, you're probably happy, or you're probably content looking around saying, I don't see what the big deal is. My stocks did fine. But if you were pretty much anywhere else in this market, it was a tougher week. Real estate at the bottom, with healthcare and technology. I think I misspoke earlier saying real estate was a pocket of strength, and that was supposed to be energy and financials as the pocket of strength. But we saw real estate at the bottom, healthcare and technology, and then on the upside, it was energy, financials, and industrials at the top of the list. We did talk about energy and financials in our midweek update. So on our Trade Ideas video series on Wednesday, we talked about the sort of leading behavior out of energy and financials, very looked similar to the way we started 2021, where technology really didn't do so hot at the start of last year. If you recall, it was kind of flat to down, and we really saw the big leaders here of energy and financials that were leading the charge early last year. So we're getting a little bit of a repeat there, although there's obviously some different dynamics at play. If we take a look at correlations here, I think what's interesting, notable is the Dow Jones. You can see how this is decoupled from basically everything. Remember, when we were looking at correlations over the last 2 weeks during the holiday period, we essentially saw risk assets all moving together. They were all super high correlations here, bright green and bright red on this chart, and you're starting to see a little bit of a breakdown here. You're also seeing a breakdown in energy or oil specifically versus equity markets as well, going pretty strongly negative to what the Nasdaq is doing right now. So those are some kind of decoupling there, and some things starting to trade on their own merit once again. If we take a look at VIX, here's what's interesting is that despite a pretty poor week here, the VIX didn't get that excited to the upside. We are actually still south of 20, which is a bit surprising given the fact that we've seen some bigger moves. We've seen some concern out there, some fear out there. We've seen individual stocks get hammered this week, but the fear index here, volatility, is actually 18.84. So that's interesting to me. Up from last week, of course, but not skyrocketing to the upside. So we'll have to see if that's just complacency or if that's resiliency in this market. Maybe people have protection kind of in place right now, and if that is the case, then generally speaking, the market tends to find a floor, but we'll see how that obviously plays itself out. If we take a look at interest rates, this was obviously the big story here. The Fed's more aggressive stance here on fighting inflation, raising rates, and what their timeline and schedule is. We saw yields jumping this week, big across the entire kind of curve term structure here. You can see all the way down, mostly on the front, was getting the more aggressive moves. Big moves here, and that's why bond prices really got kind of obliterated this week. So we're seeing big moves there. We saw credit markets also responding here and selling off pretty aggressively. So this, clearly at the center of the narrative driving a lot of this action. If we take a look at dollar and commodities, you can see the dollar index was up a little bit this week. Didn't do a whole lot, started strong and then kind of tapered back a little bit, but still managed to close up. Gold was down, silver was down, Bitcoin getting hit quite aggressively here. Crypto markets, generally speaking, selling off this week, right in line with risk assets. And we did see, again, commodities here, broadly speaking, I guess, holding up. Ag was holding up as well. Crude oil, again, very strong. We talked about that. Natural gas also strong into the first week of the year. So the report card, putting it all together, not a whole lot to like this week. We did see some risk sectors, and we saw the energy, we saw financials, we saw some things that were performing and kind of hanging up there. It barely got the check mark, but it gets a check mark, saves it from an F. We get a D here for this week. Now let's take a look at how we are invested. Look at this, pretty aggressively long here. So the narrative, or the understanding of how these two trading systems have sort of navigated this week, is that we started the new year in that very neutral stance. So remember, if you recall from last week's video, you can watch it on our YouTube channel. We were basically flat coming into the new year, 50% long, 50% short, and I'm rounding there, but more or less, we were effectively neutral coming into the market. And what both of these trading systems did was kind of open up their arms and essentially take on risk, accumulate some positions here as this sell-off got underway throughout the week. So going into next week now, you can see pretty aggressively positioned here along this market right now. Our top system is basically fully invested, and our shorter term system here is, you know, pretty much fully invested, but a little bit of room left to potentially pick up some positions. So be very interesting to see how this all plays itself out. Clearly, you can see where what the systems are looking for here is kind of leaning into this market, into this sell-off, and you know, obviously we're looking for higher prices in the short to intermediate term. Remember, risk management, though, is the most important thing. You got to be very careful trying to just blindly follow these two trading systems based on this exposure. I would highly recommend just taking a trial and, you know, testing things out that way, because we are invested in specific stocks, individual stocks. We're not just buying the S&P or something like that. It's particular stocks, particular sectors. So that is the way we're positioned. That's our roundup there on the data. We'll be back here with part 2 with some charts in just a second. All right, we are back here. We've got TC 2000 open. We've got our equity market grid we're displaying. So we've got the S&P in the top left, Nasdaq top right, Russell bottom left, and international stocks via the ACWX ACWX ETF in the bottom right. We have our custom smart trend filter applied to these charts. Those are those multicolored dots you're seeing. If you're a TC 2000 user, you can get those on your platform as well. Helps us measure trend strength very objectively and without any bias. And so here's a weekly chart of the action of the major indices here. And you can see we've got no change going into this new year. So again, we've got this headline, a number of poor performing stocks. We see the sell-offs. We've got, you know, one of the worst starts to the year in a handful of years. But when we look here at the weekly chart, we're not seeing any real change of trend character just yet. You can see lots of things are kind of hanging on. Russell 2000 in particular here is skating on very, very thin ice. You can see that it's still in this neutral chop zone where it's been basically for the past 12 months. And it is below our trend filter here. So this is definitely at risk of turning down and producing the first sell signal that we've seen on a weekly time frame, going all the way back to the start of COVID before the Fed intervened in the first quarter of 2020. We have not seen any equity market, any US equity market print a sell signal here on this indicator, on this simple trend heuristic until or since 2020 quarter one. So we're still kind of waiting to see if that will happen. That is definitely the index here that is on the thinnest of ice. If we take a look at the S&P 500, again, 2% sell-off, still above our trend. We're still printing a green dot here. In fact, we actually transitioned up to a fresh buy signal for the S&P 500 this week. I know that's weird. I know that's counterintuitive, but on a time frame of this duration, the trend is still up here for the S&P 500. Short-term action looks poor, but longer-term action is still hanging in there. Got a fresh buy signal on the S&P 500. So I guess not everything stayed the same. There was a change. That was a change. Nasdaq stayed the same, still in its chop zone. Back now below our smart trend filter, so this we'll have to watch closely. And then international stocks still kind of hanging sideways, no change there as well. So all of that is the weekly sort of framework. If we go down to the daily chart now, you can see that things are much more messy. Basically, you know, sideways to negative is kind of the outlook here. And so the S&P 500, again, not a sell signal, but certainly below our daily trend filter and now printing yellow here. So it's basically flashing a warning sign on this daily chart saying, okay, the trend is potentially changing here, but the prior signal is still to the upside. Nasdaq flipped bearish here on Friday, so we finally got enough confirmation to the downside to flip that daily trend filter back to the sell signal. Russell 2000 hanging on ACWX hanging on and actually trying to turn up. So those are the high level trend analysis there, trend and price and volume. Let's take a look at some candlestick analysis here. Let's go to this frame here, this chart here, and I think this really kind of tells the story, or really gives us a very clean look at price structure here. 472, that was the level we wanted to see us stay above for the S&P 500, and we usually are looking at the cash market, which would be basically about 47.20. This was the area that we wanted to see the S&P 500 hold above. And so we, broke out to new highs right after Christmas, right after the Christmas holiday here on the 27th. We proceeded to move sideways, just high and tight for about 5 or 6 days. And then, of course, Wednesday of this week was the abrupt or the aggressive selling, which broke us back down. So what this has created for us at this point is essentially this failed breakout up here. And so that is obviously a short-term bearish sign, short-term bearish development for you short-term active traders that are looking to acutely manage risk. There's a good rationale to essentially not be long the S&P 500 until we can, get back over 47.20, 47.30 zone and hold above it. That's a perfectly reasonable stance to have given the action that unfolded here towards the end of the week. But as we let's go back to the SPY chart here, as we sort of looked at from a more broad perspective, long-term trend remains up. This range is, the range we were in since November, and we're back into this range now. And so, the more intermediate term case is, some dancing around back in here, some filling back into this zone, maybe just a messy sideways, rough kind of first month of the year. And maybe it's between, call it 450 and 470 in the S&P 500 that we get to hang out in some more like we did in November and for most of December. That is, kind of the mixed case there, where you're not breaking down, you're not just trending up, you're just moving sideways and chopping around, which is, again, a very normal sort of path or state for the market to be in. Doesn't always have to go straight up or straight down. So let's keep an open mind for now. 472 on the upside, that's what you'd want to see us get back above if you're bullish. And otherwise, this 450 zone, the lows from December, are going to be important to hold. That's where you want to see buyers step back in. You don't want to see us cratering back down below 450. That would start to invalidate lots more intermediate to long-term trends for the S&P 500. So that's the levels I'd be paying attention to. If I'm looking at the Russell 2000 here, the Russell is, just back into this same old kind of messy range it's been in. It's, to me, not necessarily worth over analyzing this market here. We like to look at it for relative outperformance and underperformance, but frankly, it's back in this, sweet spot of, again, just consolidation and mess. And so, there's those little micro levels we can look at. But generally speaking here, it's just back into a very tough spot to navigate. So for me, until it starts breaking below 208, or if it can still get more strength above 225 and then 230s, then it's kind of just more of the same. The Nasdaq, this one here kind of sits in between, and this one certainly had some violent selling this week. You can see the old highs from September, which I do have on here around 382. That's where, kind of the lower end of this range has been. But, if we really want to sort of clean things up, this is the view we're looking at here. It's just this consolidation. We've been moving pretty aggressively from the bottom end to the upper end, and now we're back to the lower end here. We're down 4 days. We're at support. This is where you would expect some type of bounce to kind of set in here. And this is, of course, where, you'd expect maybe a rebound here on Monday. If this market's going to hang in here, that's the normal behavior to keep the same old, choppy sideways action intact. Now, if we start Monday with some, big gap down, heavy volume, then that's a definite change of character here. at an inflection point. So that's something, again, we'll just keep an eye out for. Hasn't happened yet, not saying it will, and we'll certainly just keep that eye out. But we're at this inflection point. We're at this support area where buyers have stepped in multiple times now in the past month. We'll see if they can do it again. Generally speaking, though, the longer term trend is up and we're back at the bottom end of the range. So that is the view there on the major markets. Again, we talked about the VIX earlier and how the VIX has been a little bit stubborn here. It sold off kind of into the weekend a bit, closed up around 18 or so. And so this is, not that concerned, doesn't seem to be that concerned of some impending, severe selling that is going to continue on the horizon. I would expect, I was sort of expecting the VIX to maybe go out, over 20, but it's not happening. So that, I think, is a bit curious here that it's staying down. You could look at that as maybe a glass, maybe half full sort of outlook there. If we take a look at TLT and some of these bond proxies or bond markets, that they were certainly beaten up aggressively this week, and they are now back to, I think a weekly chart shows it, back to sort of these October lows. So you can see TLT, the long bond down there. You can look at IEF, the 10-year bond fund, starting to, break down here, heavier volume. So this looks a little dicey. You can throw on Bollinger Bands. We are starting to get a little bit ahead of ourselves on the downside. So I wouldn't be surprised to see some type of snapback here early next week in bonds. But again, can that hold? Is that a good bottom? Is that going to be just a dead cat bounce, or can we actually lift off of these lows? We'll have to see again how the follow-up comes on Monday. Now, let's just jump right into some of these sectors and industries of interest. So these are sectors and industries that are making notable moves. If we look here on the upside, the list is a bit shorter, and it is mostly filled with gas, oil and gas, and financials. So again, if you look, for instance, let's go to a weekly chart. Take a look at regional banks this week, totally ignoring literally everything else going on in the market and breaking out to new highs, doing it on volume. This looks like a picture perfect breakout right now for regional banks. So that is definitely some bullish behavior. Oil and gas, E&P specifically, breaking out to new highs. We've got banks globally here, financial services sector breaking out to new highs, more oil and gas, the integrated industry here breaking out to new highs, XLF breaking and closing at new highs, energy, XLE, Spider breaking and closing at new highs. Both of these markets looking really picture perfect. If I showed you these two charts in isolation and didn't show you what was going on in the market, you'd probably think the market's doing pretty well. Those two sectors really kind of standing out. Again, more oil and gas, defensive area, tobacco, insurance, kind of in the financial space, more insurance, farm and heavy construction machinery. So industrials getting a little bit of lift up here as well. Aluminum getting a lift up, more banks, more oil and gas, more banks, right to the start of the list. So that's what was working. Everything else that was not working, there's too many names here. I'm not going to run through all of them. I'm going to expand this list so you can take a look at all of these yourself. So if I'm just going to open up these columns here, you can click pause on the video. You can take a look at what is notable. I think what I'll go through right here is just the high level sectors. So you can see real estate making a big sort of outside, or really a bearish engulfing week here on heavy volume. We see biotech, really aggressive selling going on here, 8% down. And this was already working itself down. So this selling here, just really the trend that has been in place since mid last year, still in place. Semiconductors, high volume, notable outside reversal week. We see consumer discretionary, also an outside reversal week. And then you can take a look at some of these other industries in this list. So that's everything rounded up for you there on what happened on this first trading week. I'd love to hear your thoughts. There was a busy week. How are you thinking about this new year? How are you thinking about January? What's your positioning? Leave a comment below. Always love to get that feedback and see if we can help others that are, watching this video and trying to navigate these markets. So that's it for me. As always, thank you so much for tuning in. Every Friday we do these videos, so subscribe on our YouTube channel if you like them. Also, you can check it out at thetraderist.com, always posting these videos there as well. So have a great weekend. We'll see you back here next week.